Welcome to VTS Options. So today I'm going to go over the second of the two building blocks for all of advanced options trading. The first was the long call, and today is all about long puts. These two simple options, calls and puts, are part of the makeup of all the other cool option spreads you've probably heard of. So iron condors, calendars, broken wing butterflies, strangles, all that cool stuff. So subscribe to the channel if you haven't already, smash the like button for me if you do like options trading content, and let's talk about the long put option. Let me quickly go over the theory here, show you the risk profile of the long put, as well as the effect of all the major option Greeks. And then after that, I will jump into the trading software and show you a real example. This is the risk profile of the long put. They all look like this. We've got the price axis here, and then what the long put risk profile looks like at expiration. Now to open one of these is very simple. In your trading software, you just buy to open a long put. I'll show you that again in the example shortly. But since it is best to learn from examples, here's a hypothetical setup. We've got stock XYZ currently trading at $60, and we're going to buy to open a $60 long put option for a premium of $5. Now that curved pink line is actually the one we're going to focus on. That's the daily profit curve, and it will show us at the moment what our trade is valued at. So at the moment of opening the trade, of course that's going to be zero. And then over time it'll shift up or down depending on whether the trade is profitable or in loss range. So down here we have the maximum loss for the trade, which in the case of long puts, that max loss is capped at the premium paid. We can't lose more than that. Since we paid a $5 premium, we can multiply that by the options factor of 100, because each contract represents 100 shares of the underlying. $5 times 100 is a maximum loss of $500 for this trade. Now the max gain, while it is technically limited because the stock can only go to zero, actually, there's plenty of room to the downside, and practically speaking, the upside profit potential is still very large. Lastly, the break-even point at expiration is the strike price minus the premium paid. So we're buying the $60 strike for $5. That makes the break-even at expiration $55. For long puts, the break-even at expiration will always be lower than the price it was when the trade was opened. So it has to move in the right direction for us to be profitable. It's a bearish trade, so we do need the underlying to go down. The option Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. There's many Greeks, but actually only three that we focus on, covering the three most relevant factors in options trading: price, time, and volatility. Delta is an option sensitivity to price. Long puts are delta negative, meaning they profit from decreases in the price of the underlying. Remember, it's a very bearish trade, so it's delta negative. Theta is the option sensitivity to time. Long puts are theta negative, meaning they do lose value with the passage of time. Whatever move you're expecting in the underlying, it's best if it happens sooner rather than later so the negative theta doesn't eat away at too much of the position. And lastly, Vega is an option sensitivity to volatility. Long puts are Vega positive. They gain value with increases in volatility. So ideally, they are best open during periods of lower volatility as a starting point, which would mean there's a little more room for volatility to go up and the trade to benefit from that positive Vega factor. And a little added benefit of this Vega factor, because it's a bearish trade, if you're right and whatever you're trading goes down, that typically does coincide with increasing volatility. So they can be extra profitable if you get the right move. So that's the risk profile of the long put, as well as the three Greeks that we focus on. Feel free to come back and reference that table anytime you need it, but now let's get into an example. Okay, so this is the Thinkorswim platform from TD Ameritrade. And right here, we're looking at the S&P 500. This is the SPY. You can see recently we've broken to new all-time highs, so everything in the market is seemingly pretty stable right now. Now remember, I mentioned that long put options are long Vega, and you do want to open them when volatility is relatively low. Conveniently, that does typically happen when we see markets near all-time highs or at all-time highs. Volatility will typically be fairly low at this point. Long puts start to look a little bit more attractive at this stage. Now, there's two ways that they're typically used. The first is just pure speculation. If you see something and you think it's going to crash, you can buy a long put on that. The other way is more of a hedge. Maybe you have a broad portfolio that is fairly bullish, and you want to buy a long put to hedge a little bit of that downside risk. So for today's example, I'm going to do both of those at the same time. And how I'm going to achieve that, go to the Analyze tab here. Typically for long puts, people would be looking about 30 days, maybe 68 days out That's a good time horizon to keep that theta value a little bit lower. But for this example, I'm actually going to stretch it all the way out to this December 2020 contract, 369 days from now. This is why I say it's serving as both a speculative bet that maybe the S&P 500 will see some type of decline next year, and also a pretty good hedge, because the contract is going to have a full year, and it means if the other part of my portfolio is a little bit bullish, I'm going to have that coverage for a full year. So as far as what strike to choose, you can see here the at the money is about the 317 put. But with a year on the contract, the at the money is a little bit expensive, probably a little more than people are willing to spend. And so what I like to do is I like to go a little bit lower. Now, just in recent action, we've seen the SPY as low as 300, we've seen it down in the 290 range, so somewhere around there is probably appropriate. We could look at this 300 strike. You can see there's a pretty heavy volume on that strike, so that's probably a good one. Let's just go ahead with that. So how you do this, it's very simple. You just buy to open a single put option. And it looks like this. This is what all long puts look like, this familiar shape right there, that turquoise line. Now remember, this is what it's going to look like at expiration. But what we're more concerned with is this pink line, the daily profit curve. You can see right here is where we open it. It's going to be about $0 because it's a fresh new trade. But as we move down, if we do get some decline in the S&P 500, the profit can start to build right away. You don't have to wait till expiration, and to be honest, I almost never do. So I'm only ever concerned with this pink line. But it does need to be said that the break-even point for all long puts is going to be below the current price. So right here we are about the 317. You can see at expiration, the break-even's all the way down here. This is very easy to calculate. It's just the strike price, which is 300, minus the premium paid, which in this case is $14.54. Since we're paying this, it's a debit. That's why the break-even is going to be well below the current price. But again, we're just going to focus on this pink line. So going over the Greeks, of course, this is a delta negative trade. You can see that white number there, minus $51.20, or right here by today's price, minus $34.39. It's a negative number because we do want the S&P 500 to go down. That's what makes it delta negative. It's a bearish trade. So as the price starts to drop, that's when we're going to be making the profit. When we look at the theta, remember we said that this is a theta negative trade. So again, we're going to hover right on today's price. I don't know if you can see it up there, just barely. It says minus $2.80. That is a daily theta decay. Doesn't sound like much, $2.80, but of course that will add up over time. I can show you a little adjustment here. We'll go back to this main picture. You can see we're basically starting right about $0 because we're just opening the trade. If I do a little calendar adjustment, we're just going to go forward 3 months. You can see what happened. All of the Greeks adding together, this is anticipating that this trade will now be down $292.74. Nothing would have happened. The price stays exactly where it is, but the trade will now be in loss range, and that is because of the theta decay, losing a little bit of value each day. That's why we say whenever you're doing long puts, you do want the action to happen sooner rather than later. But this is a long-term hedge, so a little bit of theta decay is expected here. And the last Greek we'll check out is Vega. Now, long puts are Vega positive, right? We are long volatility in this case. You can see this number up here, $116.13. What this number means is if the volatility on the S&P 500 goes up by 1%, our trade will increase in value by $116. So increases in volatility are quite advantageous for the long put. And conveniently, of course, if you imagine what were to happen if this trade starts to be profitable, say over the next couple of months the S&P 500 sees a 10% drawdown or something, volatility will spike up in that case. And that's when that Vega can really start to add up for us. So again, I can show you a little bit of an adjustment here, starting at around $0 there. If we just do a little volatility adjustment, say up 10%, look at what the trade did. It jumped up to $1,175. Again, the price would not have moved, but because that volatility increased, our long Vega trade is now comfortably profitable. And of course, the price would be somewhere down here because it's happening because of a 10% drawdown, like I said. But that Vega boost that you can get can be substantial. But that's the long put. Like I said, in this case, it's serving both purposes, both speculative. Maybe early next year, mid next year, there's a big S&P 500 crash. But also, it is just a good idea to carry some longer-term hedges sometimes. If I had this trade open, it would probably allow me to throw up a few bullish trades, knowing that the downside is going to be covered by this long-standing hedge. So while I don't trade these very often, they are actually a very important trade. They're a very useful trade in the right circumstances. And it's certainly a building block to all the more exciting trades, so we do want to get comfortable with the long put. So that's the basic long put. It is a very bearish trade, so it's really only appropriate when you're expecting the underlying to make a strong move down. And remember, because they are theta negative, whatever move you are expecting in the underlying, it's definitely best that it happens sooner rather than later in the option lifecycle. The longer we let these go, the more that theta eats away at the value. These are limited loss trades, which is good. It means risk management is fairly straightforward. The maximum loss is capped at that premium paid. And while they are technically limited gain, because the stock can only go to zero, in a practical sense, if the chosen stock does go down substantially, there's plenty of room for profit on the downside. The other side of that coin is, because the break-even point is that strike price minus the premium, meaning the stock has to move in the right direction to be profitable, these are considered lower probability trades, and statistically speaking, if left alone, most long put options will expire worthless. But that's it. That's the long put option. Very simple to set up, and the risk-reward profile is about as straightforward as it gets. Whatever you're trading, whether it's a stock or an index, you do want that thing to crash. Now, understanding the structure of the trade is a good first step. But the real key is how to actually use them in the context of a broad, diversified portfolio. And for that, head on over to my website, claim your free 2-week trial, and check out some of my live trades in action to see if the VTS community is right for you. Thanks for watching. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.